Hey everyone, John Henry here from School of Trade, and today we're going to be taking a look at supply and demand zones. So first, before we start, what is a supply and demand zone? Well, a supply and demand zone is an area of support or resistance where buyers or sellers have come in strongly to defend a specific area. So as an example, we have an indicator here that plots these supply and demand zones on the chart for us, where if we're looking to move down, as an example in this case, and we're coming into a supply zone or a demand zone. So a supply zone is up top, a demand zone is down bottom. If we're coming into one of those areas, we should be looking to see those buyers who came in strongly back here should come in and defend that area once more so that they can basically add to their positions at the same price they bought it for back a couple days, a couple weeks, depends on the chart time frame you're looking at. So it's a way for them to get in at essentially a break-even position, as well as where you're going to see a flood of buyers come right back in. It usually indicates cheap price. So in this case, you can see on the 60-minute chart, if we zoom in a little bit, back here, we had a big block of buyers come in and created this demand zone down here where previously buyers were coming in and really hammering this market up. You can see the sellers tried and tried and tried, immediately rejected it right back higher again. And usually these demand zones are pretty well defended, meaning that if you come back near them or touch them, they're going to get bought again. So we came down here, came kind of close, bounced back up again. Now we came back down and physically tested it, only by a couple ticks, bounced right back up again. Those are the buyers defending that demand zone. And the same goes for the supply zones up top. We have a untested supply zone up here, so chances are that if price comes back up into this range between 101.04 and 101.38, we should see price reject right back out again. Now, there's a couple different ways that we can use these to trade off of. First of all, what we just talked about is a reversal pattern. So looking for a zone reversal. Price comes into it, bounces back out. Now, you can use those in a lot of different ways. You can use the 60-minute zone and then immediately switch over to one of our entry charts and look for a wave pattern to get in. Or you can use it just blindly buying it on the level. Obviously not recommended. It's usually better to find a pattern. There's a lot of different ways you can get into those, but looking at the overall area between 99.43 and 99.11 here, we saw a price bounce up from those lows. So we could go to any type of time frame or any entry chart and look for a reversal out of that area to buy it right back up again. Now, the next way that we can use these to trade is a zone failure, meaning that the zone doesn't hold up, the buyers just lost their steam, and it just went right through it. Now, as an example, if we were coming down here, came into this zone, and the buyers just didn't have enough, they couldn't keep it up, and we eventually start breaking through. Well, just like as anything else with whether it's a moving average or a trend line or a channel, whenever support gets broken, it turns into resistance. So what we'd be looking for is after price breaks through it, we'd be looking for it to come back up and retest it from the opposite side of things, and then come back down again and get rejected as a selling opportunity. And the same thing goes. When we come back up into that area, we could zoom into a faster time frame, look for a wave pattern to hop in short, and just take a short right down there using a nice little pattern to get in. So we can use it as in terms of if the zone fails, we still have an opportunity to trade it. Now, the next one is looking for specific patterns. As an example, a double bottom. So waiting for price to come down into the area, into a buy or sell zone. And since we've been focusing on the buy zone so much, let's look at the sell zone. So we come up into the sell zone and say price comes up, reaches that high, maybe goes a little bit past this 101.38, and then rejects right back down again. Looking for those double tops and double bottoms to look for an opportunity to get in this case, short to bring the market right back down again. And then the final one is looking at the closing bell of whichever market you're looking at. As an example, crude oil. Coming into the closing bell, looking at today even. The price predominantly today has been up. We've been going up and up and up and up. And what you want to do in terms of using it with the closing bell is trading against the daily trend. And the concept behind that is looking for the traders who have been long all day to start taking profit off of the table going into the close. And what I mean by that is we'll switch over to the 1-minute chart really quick. And you can see we came into a sell zone on the 1-minute chart. The trend today was very firmly up, and we can see that right from the beginning. We bounced out of that buy zone and have been moving up the entire day with really only one or two pullback candles. Now, if we switch over to the 1-minute chart, what we can do is look for a sell area to show up and then price to pull into that area and reject right back out again. And essentially what we're using that for is to find out where the sellers are coming in historically and looking for them to maintain that area and start taking profit back down against that daily trend. So just a little bit of a different way to look at it, but definitely a really solid way to get some pretty high percentage trades. So that's going to be taking a look at supply and demand zones. If you have any questions about it, feel free to send an email to School of Trade, and don't forget to check out our trial at schoolattrade.com. Have a good one.